Let's have another look at the markets and how they are trading so far today. Investors continue to digest the latest economic data on both sides of the border, and of course the prospect of huge tariffs on Canada and Mexico, and Donald Trump's latest picks for his cabinet as well, his nominees. Let's go to an investing expert to get his views on these markets. Martin Pelletier is portfolio manager at Wellington-Altus Private Counsel. Martin, thanks a lot for joining us. What is your take on equity markets as we inch to the end of the year, where they are well into double-digit gain territory?
There's a lot of excitement, a lot of euphoria, and a lot of confidence. I read the other day that almost 60% of Americans think stock prices are going to be higher over the next 12 months. That's the highest level of confidence in history, going back to when data started being recorded. Can't blame them. The the S&P 500 is on track for back-to-back years of 20% gains. And the last time that happened, was 1998, 1999. And a lot of that has some of that's flowed into Canada as well. TSX has done fairly well. Thanks to things like the Canadian banks doing very well, and so there's a lot of confidence. A lot of people are going to be happy heading into Christmas time. What
do equity market investors do when they look at some of the multiples on S&P 500 stocks? You make the point in some recent notes that multiples on the top 10 S&P 500 stocks are now approaching 30 times expected earnings.
Yeah, that's higher than the 25 times we saw during the 1990s, the dot-com boom. There's a few of us out there that were in that in that market, so we do remember, and it doesn't seem that far away, but for a lot of pros in the market, the average age is 30, and so that seems like a distant memory. You've got price earnings multiples. Tesla's at 94 times, Nvidia's at 54 times, Netflix at 50 times, Amazon 44, and I'll keep going. Price to sales, 30 times for Nvidia, 13 times for Microsoft, and Tesla at 12 times. And so you have a market that's really expensive. And so the natural go-to for investors is, hey, let's look at what's cheap and what hasn't moved. And that's what you typically see during a strong market rally. But the risk about doing that is you just own something of a lower quality. And if markets do correct, you're not going to be protected. And so it creates a little bit of a conundrum for investors. What do you do? And so I think now's probably not a bad time to trim back some of your equity if you've had some strong gains, and redeploy it into other areas that we think look more attractive.
So you've been layering on some risk management strategies, and you've made some changes to your bond allocation as well. Take us through what you're doing to mitigate the risk that you have just outlined.
Well, okay, so the natural go-to is to own bonds and selling off your equities. Well, the problem is, which bonds do you own? The Canadian bonds and a depreciating currency like Carl was on previously with you, and Canadian dollar at 68 cents and shivers down my spine. So you want to own U.S. dollars, in my opinion, as a hedge. But owning U.S. bonds, well, the U.S. debt is massive, and their deficit is being run like it's World War II, and that's concerning. And so you don't want to own the U.S. Bonds. And so what we've been doing is we've been shifting more towards structured product, which is really good for us. For example, we just did some structured product this week where we can track Canadian blue chip stocks paying nice dividends and maybe a little bit of safety from the tariff exposure because it's in Canadian banks, pipes, that sort of thing. That'll track the upside 1.7 times, but over the next 2.5 years, with 100% downside protection. We did one on banks that will track the Canadian banks 1.25 times the upside with 100% principal protection over the next 2 years. And we did one on pipes that will pay a 14% coupon payment if these pipes are above 0% in 12 months and roll over to the next year 28%. And so as a safe way of investing, these structured products are providing a nice alternative to what we think to be a very scary equity market from a fundamental standpoint, and bonds. And maybe very, very scary is too strong of a word, but just very expensive. and in bonds that just aren't looking to move here with as long as the government spending continues.
One sector of the equity market you like is Canadian dividend payers. Why don't we finish there? Why do you like them, and what's your checklist before you buy a Canadian dividend payer?
So do not chase yield. That's the golden rule. And if it has a higher yield, there's probably, there is underlying issues. And so I call it the value trap. So you buy it because it looks cheap, the company spends money, or has a really bad, nasty balance sheet, erodes the value of the company, and then it continues to trade at a discounted multiple. And so you want to be careful there. And so, we want to stick to quality that they can sustain that dividend through tougher times. So a lot of the Canadian banks have done phenomenally well. Royal Bank is an excellent bank that's done well for us. Brookfield Infrastructure Partners, the Brookfield pieces of what they're offering out there. Brookfield Asset Management, that's not really a dividend, but you got Brookfield Infrastructure Partners is paying a nice dividend. You got Pipes and Bridge, TC, you got that have done fairly well, that will continue to pay their dividends. And the utility companies, they're going to benefit from falling rates in Canada. All of these, they do have higher balance sheets, higher debt on their books, but it's backstopped by operations that are a lot more stable and secure than some of the other industries. And so having a portfolio of those kinds of names against the backdrop of 94, 54 times earnings in the U.S., I'm just old-fashioned, and to me that looks interesting.